Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we're going to learn a concept which is known as non-current assets, which is a part and parcel of the balance sheet. Balance sheet on the asset side, non-current assets have been recorded. Right, so we are going to learn this. There is an extract over here, as you can see, of assets. You have current assets, all the liquid based assets which can be converted into 1 year of time span are here, which gives our total current assets. Then we have tangible and intangible assets that have been recorded. Prepaid revenue, these are not intangible assets, just the part of the assets, the prepaid revenue, the non-marketable investments, deferred income tax, property, plant and equipment, the intangible assets, and so on and so forth. So what are non-current assets? See, an asset is something which has, remember, economic value, and it is held by the organization for the benefits in present and future. So assets are broadly classified into two categories based on the time period which they are expected to be converted into cash or used for the business. First is we have current assets, assets which are likely to be converted into cash or used up within the 1 year of time span. Okay, and it is classified under this category. In other words, such assets are converted back into cash within 1 year period, and this assets reveal information about the operating activities of the company. Example like cash, we have inventory, we have prepaid expense datas, and so on and so forth. Then we have something called as the non-current assets. Such assets are not owned for the purpose of the converting them into cash within 1 year. So non-current assets are basically the long-term asset that have been bought within the intention of using them in the business, and the benefits are likely to accrue. You can say that within for a number of years. So this assets reveal information about the investing activities of the company. Now, this assets reveal information about the investing activities of the company. Non-current assets can be either be tangible or it can be intangible. Okay, example like fixed assets such as property, plant and equipment. We have land and building. Okay, we have long-term investments in bonds, in stocks. We have goodwill, we have patents, we have trademarks, and so on and so forth. Right, so these are all the examples. Now the non-current assets definition. See, for an organization to run effectively and generate positive return for its stakeholders, it requires investing into the long-term assets, either through internal sources, right, like share capital. They have reserves, if any, right, or through external borrowing in the form of loans, etc. So investment made by an organization in assets which are expected to be held by them for more than 1 year are referred to as the non-current assets, or also known as the long-term assets, right. Now such assets are usually, or used by the company to manufacture goods or render service for the smooth functioning of its day-to-day operation. And such assets are like, it's capitalized rather than it has been expensed. Okay. Capitalizing the cost of the asset means that the cost of such assets are not completely expensed in the income statement in the year in which they are acquired. Instead, it is allocated over the useful life, over the number of the useful life of the asset, and deducted from the cost of the asset every year. So depending on the type of the asset, this are depreciated or amortized year on year basis as per the depreciation method, which is known as the SLM. Or there is another method that's called double declining balance method, DDBM method. Right, now what are the types? Let's understand the types. The first and the foremost type that we are going to learn is the tangible assets. Let me write for you, tangible assets. Now assets which physically exist, that is, which can be touched, or tangible non-current assets are usually valued at cost less depreciation, right? So tangible assets example includes like land, we have property, we have machinery, vehicles, etc. So, however, it is worthwhile to note that not all the tangible or non-current assets depreciate in value. The non-current assets examples are like land are often valued revalued over the period of time in the balance sheet of the company, and it's also have to look at the what we say as the net tangible assets. Second, we have is the natural resources. Now, these assets have economic value that is derived from the earth and it is used up over the time. Examples include like oil fields, we have mines, and so on and so forth. These are the two examples. We'll go with the third one. Those are the intangible assets, assets that do not physically exist but has economic value that falls under this category. So for an asset to be categorized as intangible assets, the following criteria must be satisfied. First, it must be identified. Second, the organization must have the means to obtain the economic benefit. And intangible assets can either be generated internally or by business, or it can be acquired by a separate purchase made through M&A. And intangible assets example include like goodwill, patent, trademark, and so on and so forth. So intangible assets are recorded in the balance sheet according to the cost or the reval model discussed. Okay. So, however, it is pertinent to note that goodwill is not amortized but tested for impairment at least annually for sure. And for any impairment or loss is recognized in those cases where the carrying value is or the carrying value actually exceeds the fair value of the intangible assets. Now, the list of the non-current assets, what we discussed, just shortly give you a hint. PPE, that's the property, plants, and equipments. We have what we discussed as natural resources. Then we discussed intangible assets, patent, copyright, trademark, etc. We also discussed a part of goodwill, which is also an intangible assets. Then we have something called long-term investments. Now, when an investor buys security in the financial markets, they purchase with the hope that they will appreciate in the value and pay them some return, like purchase of the debt securities like loans or bonds. So the company records the purchase of investment on their balance sheet. This fourth, fifth, right, and sixth, there are some other long-term assets, if any. So in many financial statements, you will find that this item whose explanation is completely missing. So you may not need to know what is the proportion of other assets to total assets. So if it is significant, then an analyst may want to clarify the same with the management, right? So on the concluding end, what I can say that tangible assets and intangible assets, they are the part and parcel of the balance sheet. They are included in the part of the non-current assets, and they also show the financial health of the company as a whole, because assets, greater the assets than the liability is always a good situation for the company. Thank you everyone for joining the session.